Hi, everyone. This is Victor, aka Palico Cowboy. And this is the first in a series of conversations we are having to discuss growing a business, saving on taxes, and how to invest in great companies. Today, I have John Corcoran here of Rise 25, who has done thousands of interviews with successful entrepreneurs, investors, and CEOs. And we have flipped the script, and he will be interviewing me. John?
All right, Victor, thanks for having me here. And I'm excited because in this episode, we're going to be talking about your 20 tips for how to invest in great companies, the criteria that you should really be looking at if you want to find great companies and invest in those great companies. And of course, before we get into that conversation, this episode is brought to you by digitalporcupine.com. Digital Porcupine is your home for understanding the digital transformation, how it's affecting companies and the greater economy, and how you can take advantage of this greater digital transformation that's happening. Digital Porcupine does this through analyzing, dissecting, and discussing just 10 stocks, 10 great companies that are the forefront of this digital transformation. And, this digital transformation is happening, whether you embrace it or not. In fact, the pandemic accelerated it by at least 5 years. And we're at the beginning of an exponential curve of this digital transformation. But the good news is you're not too late to the game. The gold rush has just started and everybody needs picks and shovels. So how do you take advantage of this sea change happening all around us? We'll start by going to digitalporcupine.com and you can learn more about it. All right. So Victor, first, I want to talk about investing versus trading because there's a big distinction that you've articulated. You've written about it before that a lot of people don't understand. So first, start by enlightening us about the differences between those two pieces.
Absolutely, John. You hear a lot about trading stocks all the time. I like to clarify that I don't trade stocks. I invest in great companies long term that adhere to the 20 or so criteria that we're going to discuss today. And to invest in a great company, I look for these 20 things among many others to find exceptional companies that are growing incredibly fast. I like to use the analogy of a dog and its tail. If I invest in great companies, the company is the dog and the stock price is the tail. And that tail may swing one way and it may swing the other way. But eventually, if that dog is going in the right direction, the tail is going to follow it. And so trading stocks is not something I do. I'm very seldom in and out of a stock in a day or a week, a month. Most of the companies I own, I've owned for more than 6 months, a year, even 2 years. 5 or 6 out of the 10 I've owned for 18 months or more now. So I'm investing in great companies and I know that eventually the stock price will follow it. And I think that's super critical. I'm not relying on a technical analysis of a graph going up or down in a day and getting in and out of this. I'm investing in a great company growing incredibly fast, usually more than 50% revenue growth year over year, the first of my criteria, and then letting the stock price do whatever it wants.
All right, so let's get into these 20 different criteria. But before we do, I think we'd all love to know a little bit about what you were influenced by. How did you develop these 20 criteria? I imagine it came over time and a lot of different influences, but how did you put together this list of 20?
Yeah, it's a fair question. I was fortunate in 2000, June of 2000, to take one of arguably the first SaaS company public, a company called Choreo. And I was the VP of finance, went through the S1 and took this company public. And we kind of threaded the needle in the middle of the dot-com boom bust. And we survived, but in doing so, we were hosting software at the time as PeopleSoft, Siebel, Oracle, and so forth. And I had to create a lot of the metrics for this company because other software companies just didn't exist. You've got to keep in mind, this is before CRM, Salesforce. This is before the word cloud. This is before any of this stuff was going on. And so by virtue of doing that, I was introduced to things such as annual recurring revenue, having 3-year contracts where a customer would basically agree to pay you for 3 years. And while you don't recognize that revenue up front, you recognize 1 year, and then the other 2 become annual recurring revenue. And it's this phenomenal model whereby you rather than, you sell 100 Nike shoes this year, next year you got to start at 0 and sell 120 to have 20% growth. With this model, you sell 100 contracts, and next year you start at 100, and anything more you sell 20 more, you have 20% growth. You sell another 100, you have 100% growth. So you can see how the growth becomes exponential with this type of company. But it was primarily through that, and then working at various other software companies and working in Silicon Valley. I worked with Oracle for quite some time as well, that I developed sort of the knack for the SaaS company. And then these particular growth metrics are not really rocket science. I started my career with Pricewaterhouse, so I have a master's in international finance. So it's one of those, I've just sort of developed them over time to try to find the very best companies to invest in. And my criteria have kept going up and up and up, because my theory is that, hey, we have, there's 500 companies in the S&P 500. I'm pretty sure I can pick the best 250 out of those 500. So why would I want to invest in the index of all 500? And in my case, I'm actually trying to pick the top 10, or if it's the NASDAQ 100, the top 10 out of 100, whatever it is. I'm trying to pick the absolute best and fastest growing companies in the top 10. And so obviously I'm giving up some profitability when I'm trying to find fast growing companies, because they're reinvesting all of those profits. So there's a whole bunch of different factors that have kind of come in, but it's a lifetime, 30 years of taking a few companies public, of starting a company from scratch and selling it, that I've had to learn, how to look at the fundamental business metrics, the financial statements. There's only 3 of them, and each one has 3 parts. It's not rocket science, but most people don't most people don't pay attention to them. And finally, I listen to the earnings calls. I actually listen to the 1-hour earnings calls once a quarter of each of the companies I'm invested in. And it's incredible to sit and listen to the CEO and the CFO of a company, and you can hear the enthusiasm and optimism in their voice, or you can hear the dejection. And they're going to tell you where the problems and pitfalls of the company are, and they're going to tell you what went absolutely amazing. And you're going to come off of that call after 1 hour, the day they release earnings. You're going to know, should I be in this company or should I not be in this company? So a bunch of different factors.
Yeah, thank you for sharing that background. All right, so let's run through them real quickly. So number 1, you alluded to it a second ago, rapid revenue growth, ideally 35, 50% or more, and accelerating.
Yeah, and it's interesting. 20 years ago, if you had a company that was growing 20% per year, every year, quarter over quarter, year over year, you would be ecstatic. That would be an amazing investment. And then it became 30, and then it became 40. And I would say now, out of my top 10, I have all 10 companies that I own now are growing more than 50% per year, and they have quarter over quarter for at least 4, if not 8 or 10 quarters. And I track 12. I go back usually 12 quarters. So that's phenomenal growth. That means they're doubling in less than 2 years. Every year, that's the size of the company. That means that if the valuation doubles with it, i.e. the stock valuation, that the stock price has to double eventually with it as well.
Yeah. All right. And then another one you alluded to was annual recurring revenue model, usually subscription based. That's your second criteria.
Yeah, and I spoke to that point a little bit earlier. It's just basically the concept that these companies are not just going in and selling you a widget. They're actually selling you a subscription to a software model that can be any number of model. It can be a software subscription for security for your individual, for your company, a la CrowdStrike, or it can be a subscription for an SQL database to basically hold your, to store your information, a la MongoDB. It can be, a subscription to, for a software platform that allows you to do, everyone knows Salesforce CRM, and that you're paying that monthly. That is usually a 2 or 3 year contract, and so that's recurring revenue. And once this software is implemented or into your system, it's not that it's not replaceable, but most companies don't want to give it up. It's very, very sticky. At least the ones that I look for are very, very sticky. And so that annual recurring revenue model where these people, it would be like Nike getting you to agree to buy a pair of shoes every month for the next 3 years, and it automatically gets shipped to their house, and they automatically know that revenue's coming, and you never give up that subscription of Nike shoes. Obviously, we don't do that, but
there may be a few huge Nike fans. You never know, right? They need a new pair of shoes every month. All right, so that's good. So then number 3 is company size, ability to 5 to 10x itself. So I'm assuming by that, then you may not want companies that are too large if it gets harder for them to grow by that rate.
Well, sure. There's 2 factors there. The first one is I'm not nothing against Google, against Amazon, or against Apple. All obviously phenomenal companies and very safe companies to put your money into if you want to invest in them. But what are the chances that Google, Apple, or Amazon in the next 18 months are going to double themselves? All 3, I think, are in the $1 trillion valuation range. So for them to double, they've literally got to double their sales and double the size of their company. And in order for the stock to even have a chance at following that, I don't know where they are at because I don't follow them that closely, but I suspect they're still growing at 20% growth per year, which is great. But I have faster growing companies than that. So the first one is it has to have, it can't be so darn big that it can't double itself. A lot of the companies that I've invested in, were between $5 and $10 billion market caps when I invested in them, and now they've gone to $50 billion market caps, a la CrowdStrike, Cloudflare, and some of those type of things. So first, that they are not so big, and then secondly, second is that they're growing fast enough to be able to double their market cap and double their size in that period of time, whatever it is, 1 to 2 years, that type of thing. And I believe that I can and have done that for the last five years or so, identify companies that are going to double themselves in the next couple of years.
Okay. So next piece is the total addressable market and runway.
Yeah. So total addressable market, also sometimes referred to as total available market, is just how big is the market for that company? What is the cybersecurity market? How many companies out there need cybersecurity today? I'd argue every single one of them. I don't care whether you're selling widgets, a petroleum company, or whatever. And we've seen that just in the last year as oil companies are getting hijacked, by foreign states and being held ransom. And so that is a massive, massive, massive opportunity. So what is the total addressable market? And then along with that is how many players are there? Are you the only player? Are you the best player? Do you have the best possible solution to it? In the cybersecurity world, clearly a firewall that protects your servers at your house or at your place of business just doesn't cut it anymore, because everything's sitting in the cloud and on the edge. And with the Internet of Things, they'll hijack your Tesla, they'll hijack your phone, they'll hijack whatever on the edge. It doesn't work anymore. So you have to have a different type of cybersecurity, and that's where someone like CrowdStrike would come in.
Fifth piece is kind of 3 interrelated ideas: customer growth, product growth, geographic growth. So talk to us about that one.
Yeah, that's simply, when you're looking at revenue growth, the very first one that I look at, that you're looking at the past 12 months. What is the indication that it's going to be able to continue to do that? And so what I look at is what was their recent customer growth, because that hasn't necessarily been registered into revenue growth yet. So you haven't seen it on the, in their release yet and on the income statement. How many new customers do they have? And how many large customers do they have? Product growth, just how many new in software terms, how many new modules have you added? What new products are you adding that you can upsell into your existing customer base and to new customers and to capture new customers? And then geography, are you sticking to the United States? Are you expanding worldwide? Are you adding languages to your software modules? Good example of that is Asana, one of my newer investments. They just added 3 new languages. They now have 13 total languages that they're offering their software in. Obviously, each new language you offer that in is going to give you a larger total available or addressable market to sell into. And then it often also depends on what is that software address? How many companies are there out there? What's the total potential market for your product?
Great. All right. So number 6 is, you've got an acronym: Management Flesh, founder led, experience friendly, honest. Break it down for us.
Yeah, real quickly, I just came up with this quirky little acronym FLESH for me, because the management team is absolutely critical. Who's heading that company? Is it founder? Is it founder led? And is the founder still involved on some level, whether it's the CTO, CEO, or whatever, because they're going to have a much, much higher level of conviction and commitment to that company and making sure that it's successful. Are they experienced? What's their past look like? Again, back to Asana, the founder of Asana also founded this other little company called Facebook with some guy named Suck. So obviously he has some credentials, and he has some a background in starting and growing massive companies. So that's the experience. The S is just shareholder friendly. You definitely want a company that's reinvesting into the company, that's aware of its shareholders and investors, and is striving to make the company more profitable. And then honesty is absolutely critical. I look for that on all my earnings calls. I don't like duplicitous individuals telling me one thing and then doing something else within the company. I want to know that I can trust what they're doing and that they're going to be. And it leads to one of the other ones down far further down the list. And that is, I absolutely, unfortunately, don't invest in Chinese companies because they don't follow GAAP. They don't necessarily have the same requirements that American companies have inside the United States, and it's often been heretofore incredibly difficult for the United States government to enforce it. Now they're trying to do some stuff along those lines to force any Chinese listed companies in the United States to adhere to GAAP, but they're still, it's really hard to enforce.
All right. So the next one, you're going to have to help us with this one: net dollar-based retention rate.
So that's basically a number that indicates, look, if you had 100 customers last year, of those over the last year, what a portion are they spending of what they spent last year are they spending this year? If you get an even 100%, that means you've lost 0 customers. Or if you've lost 10 customers, the other ones have made up the spending, such that if they spent $100 million last year, this year they're also spending $100 million. That's just existing customers, no new customers. Now, what you look for is numbers that get excessively high, like 140, 160, 180. It shows incredible stickiness of the product. It shows nobody's leaving. Nobody's getting rid of your software. And not only that, they're spending additional dollars to buy additional modules, to access additional information, to, CrowdStrike, I don't know how many modules they have now. It's something like 20. When you come in and you realize you need this one and then this one, and then you add 3 more, and then you add 6 more, and the customer is basically, it's extremely sticky, and they are adding to what they purchased in the prior year.
Okay, great.
That's sort of a rough description of net dollar-based retention rate.
Okay, got that one. Now, number 8 is high gross margins, minimum over 50%, stable and increasing. Prefer over 70%.
Yeah, absolutely. I mean, do you, I often pose it this way: would you rather invest in a $1 billion company with 10% margins, or a $100 million company with 90% margins? That isn't actually the best example. But the point being is, you want a company that has 90% margins. That simply means that they have a hell of a lot more going to the bottom line to profit versus a company that only has 10%. All other things being equal, $100 million company making 10% margins is going to take home $10 million, and a $100 million company making 90 is taking home $90 million. So that you're keeping a lot more of it. You're able to invest it back into the company to grow it, or the profit goes back to the investors.
Okay, great. Number 9.
So I think it's absolutely critical for my criteria that the margins be a minimum of 50%. And I have quite a few companies where the margins are between 80 and 90%. And that obviously shows the ability to have that cash flow and
Now, actually, let me ask a follow-up question on that,
Yep.
because if a company has, I think I've heard this said other places, if a company has such large margins, then that could expose it to greater competition with more companies going into that area. Do you find that to be the case, or does that worry you?
Yeah, I wouldn't say that it worries me. I think, yes, anytime there's really, really high gross margins, it is going to attract competition. It is why you find many of these high growth companies reinvesting every dollar. They're not yet profitable because they're reinvesting every dollar into capturing as big of a portion of that total available market that we talked about as conceivably possible, as quickly as possible. Because again, you have the stickiness of these products. Once they capture those customers are often customers for many, many years and aren't going to leave and go away. And so yes, there is a first mover advantage, as they call it, to getting your product on the market and then capturing as many. Forget about profit, just go for growth until a certain point, and then once other players will eventually catch up. But by virtue of having that cash flow, if you're reinvesting it back into R&D, hopefully you're making a better product and you're continuing to innovate and stay ahead of the competition who don't necessarily have that advantage because they're behind you.
Yes.
So,
all right.
yeah.
So number 9 is balance sheet, strong cash with little or no debt. Take us through that one.
Yeah, quite simply, while revenues and profits and all that is incredibly important, you want to, one of the 3 financial statements is the balance sheet, and the balance sheet is basically the assets that you have. If you don't have enough cash, it's one of the number 1 reasons for companies going bankrupt. You need to be able to have the cash to continue to grow. You have to have that cash on your balance sheet. And conversely, you don't want to have too much debt. Some debt is good, Modigliani and Miller would argue, but from the 17th century, but you don't want to have too much debt. And so I actually look for companies that have, $1 billion in cash and 0 debt. Or if they do have debt, it's typically good debt or a very small amount in proportion to the cash that they have. It's not rocket science. It's it's akin to your own personal life. Yes, we want to have a mortgage on our house, maybe because it's at a very low interest rate and we're using it to have a house that's growing in value and so forth. But we don't want to have credit cards at 30% interest rates. And obviously, the more cash we have, the more we're ensured that we're going to be able to pay the mortgage on the house, pay for our car payments if we have car payments, and go on a nice vacation without charging up that debt. So we don't want to have the wrong kind of debt. So high cash, low debt, that's just a very basic balance sheet lesson.
Okay, so we're running a little short on time, so maybe we'll pause on this next one, but we'll cover this one and then we'll do the next 10 in the next episode. So number 10 though is enterprise value / sales, and understanding that this number is not created equal across all companies. So go through that one for us.
Yeah. Most people are used to looking at, so EV over S is enterprise value of the company. Enterprise value is typically defined as the market cap, or the number of shares times the stock price. And you usually subtract out cash and add back debt. And that gives you what's called the enterprise value. And it's basically just a general value of what is that company worth if you take out the cash and debt. It is often used for companies that do not have price to earnings ratio. So we have there's lots of companies out there, the blue chips, who have a price to earnings ratio because they actually have earnings. Growth companies, if you don't have earnings, the price ratio is zero or it doesn't exist, right? We use EV to S as a barometer to compare all of these companies that are in these extremely high growth, typically don't have earnings yet. And even if they do, you can still use this metric. And they're not created, it's not created equal, because a company that has enterprise value to sales of a really high one would be 50, 60, 70, like Snowflake right now. And you could have them down in the 20s with some of the SaaS companies that is much more, that is actually relatively low compared to the averages right now. You really also have to look at certain things like gross margins. If one of those companies has a gross margin of 90% and the other one has a gross margin of 20 or 30%, that's a massive difference. And you would expect a higher EV to S for the company with the 90, because every dollar that they sell, they're keeping 90 cents of it.
Got it. Okay. Well, this has been great, Victor. So we'll pick back up with the next 10 criteria in the next episode. But in the meantime, where can people go to learn more about you or read more of your writing and connect with you?
Yeah, I started a blog about 4 years ago, almost 5 years ago now, in 2017 at digitalporcupine.com. Where I basically just talk about the digital transformation, about the companies that I invest in. And I really try to just help people to understand how to invest better and educate them on financial literacy. It's absolutely critical for kids to learn. And it's one of the things I realized as a kid I didn't learn until I actually went off to college and studied business and finance. And it's such a simple thing on so many levels if we could teach it to our kids a little bit better. But I also see it through companies, through individuals, super successful CEOs that simply they don't own their house, they don't own their car, they don't own a stock, and they've never done an investment on the side. They just have their company. And I'm trying to help people to recognize that there are 4 ways to make money. One's a job, one's a company, but that's just 2 of them. One's investing in things like real estate that has cash flow producing assets. And the last one is investing in stocks. And you can become infinitely wealthy by investing in stocks along the way and doing it intelligently.
Victor, this has been great. Thanks so much.
No worries. Thanks, John.